Hi everybody, Leo Honeycutt back here with the continuing coverage on the coronavirus epidemic as it applies to both the federal level and the state level. Here in Louisiana, of course, we are concerned about a number of things, not just related to the virus itself, but also what about the economy and what about the oil economy, since our budget is so tied to that. Dr. Lawrence Scott joins us now, the economist emeritus at LSU and an old friend of mine. Oh, that's right. You're right. I'm sorry. I keep forgetting that. Yeah. It's good to see you again, but is it good to see you under the circumstance? How's this going to play out if our kids are at home for 2 weeks and now the president says this could go till the end of May?
Wow, this could be really good for psychiatrists, couldn't it?
Yeah.
I mean, the mama's looking for help. Please help me.
Yeah.
Yeah, I know. Well, I taught forecasting for 30 years, executive MBAs at LSU, and one of the things you learn is the more uncertain things are, the wider the range around your forecast. You'll give them a point forecast, but it could be this bad or it could be this good.
Right.
And this is one of the worst in terms of uncertainty that I've seen in a long, long time. There's two, for Louisiana's economy, there's two uncertainties out there. Number one, how long is this sucker going to last? How's the coronavirus going to last? Mm-hmm. The very best case scenario I've seen is lasting until June. Base case, maybe latter part of July. Worst case, last all year long. Well, we're hoping for that June case.
Okay, so that makes sense why they've canceled schools. We have online college only now for the rest of the spring semester. We've canceled virtually every sporting event, every major event where people get together. So
that gets you right into July, right?
That's right.
I mean, June or July, right. So hopefully that's what's going to happen. Hopefully that's what's going to happen here. The other big uncertainty, though, for Louisiana is the oil price. Mm-hmm. Because before all this happened, the price of oil was somewhere in the low 60s. It had finally gotten up into the low 60s. And then, as a result of the coronavirus, it dropped down into the mid 40s or so because of a lack of demand. China was in deep trouble, so that reduced the demand for oil. That brings the price down. Then you had this price war between the Saudis and the Russians. Yeah, man. And what happened was they had already taken about 1.6 million barrels of oil a day off the market to try to prop the price up. Mm-hmm. So they had this meeting about a week ago, and the Saudis said, what we need to do is to take even more off the market to prop the price up. And the Russians said, not only no, but hell no. They didn't want to do that. Plus, they wanted to kill the shale plays in the United States. Drive that price down, kill the shale play in the United States, because that's what's eating into our market share. And the Saudis did not agree with that, so the Saudis said, well, we'll show you, okay? We're going to drive the price down even further by pumping a bunch of oil on the market rather than taking it off. And so they dropped it from the mid-40s down to today about $32 a barrel. Now, the good news is I think this is going to be a fairly short-run hit to the oil prices.
Okay.
And the reason I think that is, in economics, we would say the demand curve for oil is very inelastic. It's very steep. And what that means technically is that when you drop the price of oil, you drop your revenues a lot. And so the Russians depend very heavily on oil revenues for their economy. And obviously the Saudis rely very heavily on that. They can't take this big drop in their revenues, I don't think, for a very long period of time.
So how's that going to shake out?
Yeah, I think it's going to shake out by the Russians blinking first. I think they'll blink first, and once they blink, they're going to come back to the table and they're going to say, okay, we need to take even more oil off the market, which will pop the price of oil back up even higher than it was before the coronavirus hit. So I think that would be very helpful, because this oil price drop just kills Houma. Just kills Lafayette. It's really, really bad for them. And as we've seen since 2014.
You think we'll see layoffs in Louisiana?
Well, yeah, absolutely you will. Especially if this thing lasts longer than I just said. If hopefully the Russians and the Saudis come to the table, fix this by the end of April, maybe not so much. But if they let this trail off into the fall time period, you're going to see even more layoffs in Houma, and Houma's already lost about 20,000 jobs. It has been really hard for them, and for Lafayette as well.
All right, so the legislative session is kicking off, and of course money's always the issue. So how is that going to play into this? Is revenue forecasting way off now as a result?
Well, I think the budget is based on the price of oil being about 54. Well, I mean, it's 32. And for every buck, we're talking about 11 to 12 million bucks. For every dollar drop. So 20, what's 20 times 12? 144 million buck hit to the budget right there if the price of oil stays where it is. Now, again, if I'm correct about the pressure on Russia and Saudis to come back to the table, then this will not turn out to be a problem for us. It'll be a short-run problem for us. Long run, I think we'll be at least in the 50s, I think, and we'll be okay.
And back again with Dr. Lauren Scott, chief LSU economist for so many years, and a guy who really knows about Louisiana, knows about the direction of what the oil industry does here. And now we're talking about, of course, coronavirus. So we were talking a little bit earlier about the impact of the oil, but I want to go to the broader picture here. If everybody has to stay home for 2 weeks to keep the kids or whatever else, people are supposed to be locking down at home, operating out of home. That means there's not as much movement, not as much eating out. How's this going to ripple effect through the economy, you think?
Well, it's not going to be good. I mean, especially it's not going to be good in certain sectors. I mean, the restaurant industry, the hospitality industry, the airline industry are really getting hammered. They're already getting hammered right now, for that matter. But I think what you're going to see, I mean, most of the good forecasts I've seen, as best we could tell, is that we're going to have not a very good second quarter in the United States. Real gross domestic product going negative for the first time really in a long time. We've been in the longest boom period this country's ever been through in its history, 129 straight months of growth, and it looks like that's going to come to
11 years.
Yeah, it's been a long time. And if you think about why is it going to slow down, well, think about this big pie that represents real gross domestic product. That pie has certain slices in it. The biggest slice, 2/3 of the pie, is personal consumption spending. That is really what's been keeping the economy going so well. People going out and buying cars and movie theaters and restaurant meals and food.
Spending and living.
Just spending stuff. Yeah. Well, people spend money based on their income and their wealth. Well, their wealth has taken a gigantic hit in the last through the stock market. The stock market has dropped, what, 30%?
30%.
So a remarkable amount of drop. It has dropped a great deal.
You know,
when that happens,
only 3 points away from the drop of the 1929 crash.
I mean, think about that for a minute. Yeah, but I mean, but when that happens, people grab onto their billfold and they hang on to it. They don't spend. So that particular 2/3 part of the pie starts to squeeze in. The second thing that happens is business investment spending. Uncertainty is the worst thing for business investment spending. It was already a pie not growing slice of pie not growing very fast, and now with this happening, you're going to start to see that go down, squeeze down even further. And then there's another part of the pie called net exports. Well, one of the things that's happened because of coronavirus is our exports to China, to other parts of Asia, to Europe, has started to go down. So that part of the pie is going down. So that all ends up being what at least one forecast is about a minus 0.6% decline in real gross domestic product in the second quarter. Now, the one part of the slice of the pie that may grow, and is worrisome to me that might grow, is government, the government spending part. And I'll tell you, because what is happening now, to look good right now, you got to be a government person, whether you're a mayor or a governor or a president. You got to say, I'm doing something, right? Well, doing something at the federal level means spending one hell of a lot of money. You know, if you're saying,
I've already heard 1.5 trillion.
Oh, just numbers that are just going to add to the deficit, and after a while that deficit begins to matter. So you don't want the growth of real gross domestic product coming out of that part of the pie. You want it coming out of the rest of the pie. So here's the deal: once we get through this thing, if we get through this thing by June or so, you're going to start seeing all these pieces start to grow again. Our exports will start to grow, business investment spending will start to grow again, and that very important consumer spending part will start to grow again. And the good news is, before all this happened, the national economy was in very good shape. I mean, all the forecasts I'd seen, including, say, Wells Fargo or the consensus forecast, which is made up of about 45 different forecasting firms, they were all forecasting growth all the way out through 2021. So no stoppage in this 129-month record that we got going right now. Everybody was saying the economy is going to continue to grow unless there is an exogenous factor.
And here we are.
The coronavirus was the exogenous factor that came out of nowhere. You could have predicted it. Boom, it hits.
Well, I know I read some of these conspiracy theories, and I think, you know, that timing really was suspect, because here we were in the middle of a trade war with China. We had the tariffs that we were fighting over. They didn't like Trump because he called their hand on stealing all the intellectual properties. And then suddenly, out of the Wuhan, we get coronavirus that suddenly shuts down everything and ripples across the world.
Yeah, and I'm not sure where this all started or why it all started. But before this started, one of the reasons that the economy is expected to continue to grow well
is we were starting to come to agreements
Right.
with China. You were seeing a very significant softening. And matter of fact, we even signed phase 1 of the trade agreement in January the 15th. Since about last November, you've seen softening there where we're giving up some tariffs, taking some tariff out. They were giving up some tariffs. They're going to spend more on U.S. agricultural goods and things like that. It was starting to look good. Then the exogenous factor comes along and just nails us here. And the problem is we don't know how long this thing's going to last.
Well, we're seeing where they've got their neck around that noose right now. 80,000 cases of the coronavirus in China. And of course, it goes down exponentially. But Italy's been hard hit. Iran's been hard hit. They've had deaths, I mean, at an exponential rate. So, and obviously that's what we're trying to shut down here, and we're trying to react to it. Now, some people are saying that we haven't seen the many cases in the U.S., but only because we don't have the testing in place.
Well, also, I think Iran and the other country, Italy, did not have this where you self-contain yourself at your own home. They didn't shut down these events and things real quickly like we're trying to do now. And that's the whole argument behind it, as best I can tell. I'm an economist, I'm an immunologist. But the whole argument behind shutting down these events is to stop the growth of the sucker. You know, do away with these big open events where there's a lot of people around. Stop that stuff. Self-contain yourself at your own home for a while, and we'll get what's happening in China. We'll have that drop off the side instead of having what's happening in Italy and Iran, where they don't do anything like that, and it's just going crazy.
Right. Well, and I heard on NPR this morning too that they're finding that the coronavirus can stay in existence on an inanimate object, metal, plastic, whatever, for up to 72 hours.
Well, that's why you can't find any wipes right now. All kinds of wipes.
You can't find any wipes.
You can't find toilet paper.
Toilet paper, anything.
Toilet paper, anything. But you need to, you know, I had a speaking engagement in Memphis this past week. I did not fly, I drove. And when I got there, my wife said, "Look, here's what you do. You take these wipes, and you wipe down the phone, you wipe down the TV remote, and you wipe down the doorknobs." You know, because it's exactly what you said.
You know, I might have to go down to TJ Ribs and get those little packets.
Yeah, you're putting them in your pocket, stealing the little packets.
Yeah, right. Now everybody's going to run down to TJ Ribs. But anyway, all right, so the overall bottom line here is if we're going to be shut down for 2 weeks, we got the kids at home, people are going to be expected to work from home, no gas consumption, no restaurants, no outside spending, everybody clamps down and shelters at home. How long before we would see that ripple through the economy? Would it be fairly quickly as far as the downturn and then a loss of jobs?
Yeah, I mean, I think it's going to start almost immediately. That's why you have the second quarter already forecast to be negative. Yeah, it's going to happen. It happens almost simultaneously because you start pulling back. I mean, restaurants cannot say to all their employees, "Y'all all go ahead and show up," even though no employees are showing up. They're going to start doing what everybody does, especially in the service industry. If you own a restaurant, if you have a doggy daycare place, okay, and suddenly people aren't going to the festivals down in New Orleans.
That's right.
That's why they needed you to take care of their. Well, they're not doing that anymore. So what do you have to do? You have to start letting people go. So part of this is going to happen almost immediately. And matter of fact, I suspect it's happening right now.
And you were also mentioning too about losses in the oil sector and the energy sector, which are high-paying jobs.
Oh yeah. Well, those are real high-paying. Now that all depends upon this. On Russia and Iraq, Russia and
Saudi. I'm sorry,
Saudis coming to an agreement. Once they come to an agreement, you'll have those back. But the oil industry already had a problem because if you're operating in the shale plays, let's say in the Permian Basin, they for a while were able to get all kinds of investors to give them money because everything was looking good. You know, price of oil was up, everything was looking good. But the returns have not come as fast as the investors wanted. So you already started, before the coronavirus and everything hit, you already started seeing investors starting to pull back on their investments in the shale plays, like the Permian Basin, the Bakken play in North Dakota, the play in Marshall. They were already pulling back, and only the big guys, like the Chevrons, the Exxons, the BPs, they were the only ones that were staying. We're going to still stay there because we've got the staying power. We can self-finance this. But the other smaller companies were already facing problems. getting financing and keeping their financing going, because the people who invest in them were tired of it. They wanted better returns. They weren't getting the returns they wanted. So you're already starting to see some pullback.
Okay, well, and all that ripples right back to the Louisiana budget.
Yeah. Well, as long as the price of oil stays low, this is gonna be a problem.
Which means now we were talking about possibly cutting state services, certainly not getting everything that all the lawmakers want with regard to pork barrel.
Well, they certainly won't get that, because you got to be cautious during this time period. It's going to be interesting to see what they base the budget on. Right now, again, it's based on a price of oil being around 54, 55.
And we're $20
under that. They're probably
that.
going to they're going to have to change that. But what do they do? Do they change it based on what may happen for only 2 months, or what do they do exactly? The revenue forecasting conference people, the people on that 4-person group, have always historically been very conservative, been very careful about how much money they tell the legislature they can spend.
Right.
So it's going to be interesting to watch those 4 people and see what they say, what price of oil they accept for the next fiscal year. Remember, that's going to start hopefully when all this is over.
Right.
It starts in July, okay? And hopefully by then the oil price thing will have changed and we'll have more sanity about what's going on.
And
unfortunately, the legislature will be out. But then,
well,
who knows what's going to happen.
Well, but he could call a special session.
He could always do that.
Anyway, it's always good to hear. I'm sorry.
Oh, yeah, hey, man.
I'm sorry. Here we go. Here we go again.
Okay. It's been a pleasure being with you.
Yeah, you too. Thank you. Dr. Lawrence Scott, of course, keeping us up to date and posted on whether or not your taxes may actually go up in this state. We're going to have to wait and see what the legislature does to it. But in the meantime, folks, take care of yourselves and your family. We'll be right back with more.